Hey guys, I'm here with Claudia Reyes with Home Source Mortgage. We are going to be going over the process of buying a home. So Claudia, what other steps needed to buy a home?
Okay, well, first of all, I'm going to tell you about the programs that we have. Okay, so we can do FHA loans, we can do VA loans, we can do USDA loans, and we can do conventional loans. So FHA, VA, and USDA are government loans. On the FHA loan, people usually need 3.5% down payment. There is an upfront and a monthly mortgage insurance. And you can only buy private residence with these ones. VA is for military people. So if you are in the military or you were in the military, you qualify for a VA loan. These programs are very, very nice because they don't have a down payment. There's no monthly mortgage insurance, and it is just for primary residence too. Now USDA loans, those are loans that you can buy properties on certain areas. I know you're familiar.
Yeah, Ingleside, parts of Orange Pass, and actually some of New Races, but it's out in the outskirts of town.
So those are zero down payment too. There's a small annual fee paid monthly. But we can do, USDA as well. And then conventional is for primary, second homes and investment properties. It's 5% usually what is required. I do have a program for first-time home buyers that you can do 3%, and we get the mortgage insurance to a third party. So these are different type of loans. Usually when I meet with people, the first thing that we go over is your income. So a lot of people think that, we want to do 2-year history on your income, but every case is different. So if you're W-2, for example, we count your hourly rate or your salary. If you have bonuses or commission income, then you're required to have that for 2 years in order for us to count it. However, like I said, every case is different. Overtime income requires 2-year history, and the employer has to confirm that it will continue. I have done loans for some people that work at restaurants, and they have cash tips. We don't count cash. But if you actually report that on your income tax return, then we can do that. We can count them. Now, self-employed, you definitely need 2-year history. And what we do is we get your last 2 income tax returns and we average. We do a 2-year history average of your income and your tax returns. And if you have a corporation, depends on how much percentage you own on the business. That's when we require the corporate tax returns. So, but definitely just keep in mind you need to have at least 2 years of history. Every lender wants to see what have you been doing for the last 2 years. Now that doesn't mean that if you have just changed your job, or let's say I have some nurses or contractors on the oil business that they went from one company to another company. It doesn't mean that you have to be working 2 years with the same company.
Yeah, and he had mentioned about the teachers and nurses. They can only be working for 6 months and they'll qualify.
Yes, actually I have one right now. The teacher, she graduated from school and then she got her contract with CCISD. She's barely going to start in August, and teachers with that letter, they actually can buy a house before even they have started the job, just with the contract that they sign with the school. So yeah, so that works really good. Now let's talk about how much. A lot of people, when they come and see me, they ask me, well, how much do I qualify for? I always tell them that the important thing is not for me to tell you how much you qualify for, but to know, how much is your debt-to-income ratio and how much you can afford actually to qualify. Because there's people that, you can qualify for way more than you actually want to pay per month. So you need to watch your debt-to-income ratio, which means that's the calculating, all your existing monthly required payments, and we're talking about credit liability. So actually payments that you have on your credit, like credit card debt, car loans, that's what we're gonna be looking at. Plus you add your projected new house payment, and then you divide that by your monthly gross income, which means before taxes. So that's what the lender looks at. They look at your income before taxes, and that will give you your debt to income ratio. So that's what we use as lenders to calculate your purchase price. Each lender has different guidelines about the debt to income ratio. Regularly on an FHA loan, like you can go higher up. Actually, sometimes over 50%, and conventional is actually a little bit more picky, and you have to be under or at 45% in order to qualify for a conventional loan. Now, your purchase price. So the purchase price is your mortgage payment minus the impound account or your taxes and your insurance. It's what's gonna go on your payment. So your payment includes your principal, your interest, your taxes, and your insurance. Now, let's look at this scenario, for example. So if you have somebody that is working at $15 an hour for 40 hours a week, that means that they're making $2,600 a month. Let's say that they have, $50 a month on credit card debt and $200 on your car loan, and then the new house payment is like $800. So the total debt is $1,050 divided by how much they make per month, $2,600. That's 40% debt to income ratio. So this person would qualify for either a conventional loan or an FHA loan, because the debt to income ratio is really low. Wouldn't you like to have just $50 credit card then?
Yes, that would be great.
And a $200 car payment.
Nowadays.
So this is how we calculate, the ability to repay, and that's very important because we don't want to put anybody on a house that they really don't qualify for, right? Like,
Yes.
we need to make sure that you guys, can afford the payment, and you're not going to be like house poor. Yeah. So now usually the mortgage is a 30-year fixed payment. So again, principal, interest, tax, insurance, and it does have an escrow account. There are some places that they're not required to have an escrow account. We do. So the only way that you can waive the escrow account is if you give 20% down payment. Other than that, you have to have the taxes and insurance on the payment every month, which it's kind of tricky. It's nice sometimes to have it at the end of the year, but you're stressing out.
Yeah, instead of one paying lump sum at the end of the year.
Well, like here, like a lot of the people, like they say, well, I'll pay with my income tax return, but if you don't get enough or anything and you don't save every month, then it's like a stress generating right there. Now your down payment. So, for example, on a $100,000 house, let's say 3.5%, your down payment is $3,500. Us as lenders, the down payment has to come from a place where we can actually track. So we have to source the down payment, and it has to be seasoned. So what that means is, like, bank deposits, we never count cash. Like, cash does not exist when you're buying a house. All deposits need to be sourced, and large deposits need to be seasoned for at least 2 months, which means, like, if you have, let me give you an example. So I have people that sometimes are like, oh, well, my mom has money in my house and is cash. Or you need to start saving money that we can actually see where is it coming from. Because if we can't source the money, you can't use it. You can use your 401k to put a down payment. So there's retirement accounts that you can actually access and withdraw money from there and use it as a down payment. You can do gifts. They have to be from a family member, and they have to be documented. So whenever you're considering like getting a gift from a family member, talk to your lender first so that we can walk you through the whole process, because sometimes people do, exchange money, and if you don't do it the right way, you might end up like not being able to use it. Another source for down payment, have you heard about the SAS program?
What is a step?
The SAS program is a grant. So they give you the down payment up to 5% of the sales price if you qualify. It is a grant, so you don't have to pay it back. I know that there's other type of down payment assistance over there, but this one is really nice because it's really like, I don't like to say free money, because you know that there's not like such thing as free, right? So the interest rate on the loan is a little bit higher, but I have helped a lot of people walk into the house without no money, like literally. Closing costs, the seller pays for that sometimes, if you negotiate, and then the SAS program gives you the down payment.
The only thing you would be out would be the inspection fees.
Right.
Outside.
You need the inspection fees.
But besides that, everything's pretty much
paid for. Yeah. So we do the SAS program. A lot of people, like, they call and they're like, oh, they don't know that they have 401k, or so talk to your lender, go over what are your options and what's going to be the best fit for you. Not everybody, every single loan is just different. Now let's talk about, let's do an example of like cash to close, okay? So let's say the purchase price is $150,000, you're going on an FHA loan, so your down payment is $5,250, which is 3.5% of that. Your loan amount will be $144,750. So what will you need? So say your down payment is $5,250, closing costs say about $6,000. I don't think that we have ever had $6,000. Like closing costs are like about $5,000 with escrow, and then your seller credit. So let's say this seller decided to help you with $4,500. So you will need your down payment and just a little bit of your closing costs. Like in this case, you'll probably need like about $57.50 to come into the table.
And what's the monthly payment on the house of $150, more or less?
I would say, well, you got me right there on the spot. I'm gonna say about like maybe $1,150 to $1,200.
Which is a lot
with
cheaper
taxes
than
and
rent.
insurance. Oh my God, yes. Especially nowadays. So okay, so let me just give you a really some tips about what to do and not do when you're buying a house. So you need to pay all your bills on time. I have had like true story. I have had people that they're going through the process already of buying a house, and they literally like forget to pay like those $10 minimum payment credit cards, and you can't buy a house if you're not paying on time. So you do have to disclose all your income and debts, any side business, child support, homes you own, debts. We need to know everything. Provide documentation of all the financial information, and be upfront about your credit. So we need to know what's going on, and we need paperwork. So lenders are going to ask you for paperwork, and it's going to help if you can. It's like a teamwork, you know what I mean?
Mm-hmm.
You have to be open to like just give them the paperwork as fast as you can so that you can close that loan on time.
And don't lie about the credit, because the lender can see everything.
Oh, we're gonna see everything.
So
yes, sometimes people think that we're not. I'm not gonna find out that they had a bankruptcy or whatever. Like they think like, oh well, it's 7 years, they're not gonna see it. We see everything. We have access to it when we run the credit, everything. We look at everything, so there's no reason to not be upfront with the information. Now, don't change or quit your job has happened that before too. don't apply for any new credit. So as soon as you apply for a house, you kind of like are like logged out. Like if you're really serious about buying a house, don't go and apply for new credit. Typical things like, you go to stores and they always want to make you apply for credit because they're going to give you
10% off or
yes,
50%
five.
off.
It's usually 5% off. It will be 50% off. Maybe I would apply more, but it's usually 5% off, so it's not that much. Don't pay off debt, collections, or charge-offs unless advised to use so by your loan officer. So listen to your loan officer. Don't just go and pay. This is like typical. Like, so you get the customers and you're like, okay, so you're gonna buy a house? No, I'm working on my credit. I'm paying my debt off, and then I'll come and talk to you. And that's like the worst mistake because you don't know how paying off debt is really gonna affect your credit. So you really need to go and check your credit and then talk to somebody about it, and then from there you check and see if what you need to do, and your loan officer, whoever you're working with, should be able to give you those tips. Don't move, like freeze. No. Like don't make any movement. No, like a house, like just like it's stand still until like we buy the house.
Yeah.
Don't co-sign or become a co-borrower. This one is like, okay, this just happened to me on a loan. So this girl, she's buying a house, and she didn't know that she could, she didn't know that it would affect her if she co-signed for the brother's car.
Mm-hmm.
And all of a sudden I'm like, you really need to go and return that car because you can't. So don't. Co-signing or co-borrower is the same as if you were buying the stuff yourself. So you have to, you don't do that, okay? Don't make any major changes to your assets structures, which means like, again, with the money and the cash, sometimes people like they go and they're like, oh, I have $1,000 cash in my house, so I'm gonna go and deposit them to the bank because Claudia said that you can't have any cash, so they go and do it like that. But no, that doesn't work.
Yeah.
I mean, we have to paper trail. Did I tell you about the time that I got an escrow contract and the customer, because we told him that we have to paper trail the money?
Make copies of the money.
Yes, he made copies of the bills. Like I seriously, I think I still have the thing because it was too funny. Like it was all like a fan looking type of thing. The $5 $100 bills. So that brings me to don't make any cash deposits into your bank account.
Keep it under the mattress.
Yeah, we'll keep that one and go and buy stuff with that and just leave your paychecks. So, do you have any other questions that you think that we need to cover?
Let's see.
So we went over cash, credit. The first step, I mean, before you go out there and there's a lot of people that they go Saturdays, Sundays, and they go and they look at houses, go to look at open houses. I mean, don't do that to yourself. Get pre-qualified first. If you have, somebody that does mortgage loans, or if you know somebody that does mortgage loans, like go and talk to them, get pre-qualified so that you know what you can buy.
Exactly, because houses nowadays, if they go on the market, they usually go pretty quick.
Mm-hmm.
So you want to put an offer in and you're not qualified, and you want to be ready when you find a house that you fall in love with. So the first step would just to be getting qualified, so you are ready to go.
Yes, because a lot of times, like, I have seen it, like I get people that come in and get pre-qualified, and then they're like, okay, well, we're gonna, I'm gonna go and I have been looking at houses that are like $250,000, but they want to pay like $1,200 a month, and I'm like, okay, so what? So it's gonna be really hard for them to find a house on the 150 after you're looking at 250. I mean, it's just like, no, that's not gonna happen. So we have a pretty nice setup. Like, Michael usually, if he runs into like somebody who wants to buy a house, he sends the customer to us. We get them pre-qualified, and then he finds a house. How long does it take for people to find a house nowadays?
Nowadays, I would say maybe a weekend max, if that. Usually I'll show them about 10, 15 houses, and out of those houses, they usually select the first, second one they saw. So,
Yeah. So you get the pre-qualification letter when we pre-qualify them, and then you put the offer.
put the offer in, gets accepted, we do inspections. Doing those inspections, we kind of make sure the house is ready to go, there's no major repairs needed.
Does people usually do they always do inspections?
Yes, I always recommend it. The inspection fees are only $275, but the $275 can save you thousands if there's any major problem with the property. So I always suggest doing a home inspection just for your knowledge of the property. So
That sounds good. And you have several inspectors that
Yes.
inspectors,
Mhm.
yeah, that you work with. And that's another thing. A lot of people think that because we do an appraisal
yeah,
for
I
the house,
consider-
we do as a lender, we have to do an appraisal to make sure the house is worth what we're you guys are buying for. But the appraisal is not the same as the inspector. So sometimes there are repairs that the appraiser would say, oh, you need to do this or whatever, but it's not the same
Yeah,
thing.
the inspector actually inspects the property and from top to bottom. So
Yeah. Okay, cool. Well, there's no questions, but I'm sure if they do, they can just message us or something, and then we'll go from there.
all right, guys.
This was good.
Bye.